Okay, welcome to the November 21st edition of the Fats, Fuels, and Oils webinar. This week, it actually is going to be a short webinar. I'm just going to give a little bit of a market update on what's going on and what's going on in South America. And then I'm going to talk a little bit about the impact of the upcoming IRA credit and what that might do to biodiesel production and the industry a little bit more broadly, and how it might impact the feedstock mix. So we'll start with South American soybeans. Our Joao has been down there and he's doing some on the field research for us. And he said that the weather there has the pattern has changed, at least temporarily, and it's gotten cooler, and they're getting sort of the daily pop-up thunderstorms that are pretty typical for the region during this time of the year. And that should, with the state the crop was in before, that's obviously really welcome, but it also should be sufficient to kind of continue to support the crop until we get to the critical pod filling stage later in the year. And then the ultimate yields will really depend on rainfall during that period. In southern Brazil, however, the storm that will not leave continues to kind of soak the farmers in our Rio Grande do Sul and in just north of Rio Grande do Sul. That storm has kind of shifted a little bit northward recently, but it still has been there more days than not over the past couple of weeks. And so those farmers really are going to need to probably replant some of their crops, and it's tough to estimate, I think, the impact on yields in that area, because I honestly I don't ever recall seeing a storm system that just sat over one area for weeks on end. But I guess this will give us some indication of what happens when a crop just gets way too much rainfall. In Argentina, it still has been a little bit drier than farmers would like, certainly. And I think probably as much as anything, that's probably what has been supporting the soybean market and soybean oil market in the past week or two, especially since sort of conditions in Brazil have shifted a little bit, at least in the main producing areas. And so I think that the market is worried and is going to worry about Argentinian production until we start to see an improvement in growing conditions. Now, it is still really early in Argentina. It's really before planting in a lot of cases in Argentina, so there's a lot of time for the crop to recover. And if the storms, or if the weather pattern will change and we do start to see more frequent rainfall, or at least timely rainfall in Argentina, I think you'll probably start to see a decline in prices, or a reversal in soybean prices, which should oddly support soybean oil prices maybe in the short term. And this is sort of why I think that. So I think a lot of what has happened, not so much in the past week or so, but over the last month maybe, has been, there's been a fair amount of spreading or oil share trading, so spreading soybean meal and soybean oil. And I think that was really, you saw soybean meal futures pop up to about $500 a short ton before they started to back off. And then when they started to back off, you started to see oil kind of start to move up a little bit. And I think that's just the liquidation of some of those short oil share positions. Last week's NOPA report was really, really bullish and continues this idea that that I talked about a little bit in the last couple of weeks. The fundamentals of the U.S. soybean oil market are starting to look a lot like we have expected them to look for the last couple of years. They hadn't really done it the last couple of years, but NOPA reported that soybean oil stocks for its member companies dropped to the lowest level since December of 2014 at the end of October. Now, October should be the last month where we see a drawdown in soybean oil stocks. They should start to build here, but there will be a little bit of an impact from the crushers still trying to match crushing volumes with soybean meal demand. And that makes sense for two reasons. One, because the oil share is still below 50%, well below 50% really. And also we've seen, and the NOPA report implied a further recovery in domestic soybean meal demand. So the soybean meal demand, the average implied daily soybean meal usage jumped up to like 114,000 tons from, I think it was maybe like 102 in September, and then below 100 for the 2 months prior to that. And so while falling soybean prices would typically suggest falling soybean oil prices, I think there still probably is some overhang in short oil share positions, to the extent that a big South American crop would provide at least some relief on the soybean meal side. Then the liquidation of those positions and potentially the establishment of long oil share positions would actually support soybean oil prices, even if soybean prices are moving lower. Now, I don't think that this means that soybean oil prices run up to 60 cents by any stretch of the imagination, in part because the other thing that the NOPA data implied was a continuation of the slower non-biofuel usage. And so that data, plus sort of the things that we hear in the cash market, which are kind of, there's not really a lot of strong demand, and then you'll get a little bit of buying and then kind of goes quiet again, a little bit of buying, then kind of goes quiet again. Part of that is just the timing, because we're not in sort of the, I guess, the peak period for Q1 coverage. Most people have Q1 coverage on already. Q2 coverage, I think it's still maybe just a little bit early. And so that the cash markets reports don't really capture the complete picture on demand. But just from a day-to-day perspective, if you're sitting on a trading desk at a crusher and you're getting just these little bits of demand, it may seem kind of slow, and that's what the price reporters are kind of saying, is that it just seems a little slow and a little quiet. Again, I think part of that might be slowdown in non-biofuel, although it may also be a function of, as prices come down, buyers tend to wait a little bit longer and be a little bit more patient. And so it may also be that buyers just generally are hesitant to extend coverage because they want to see if prices will come down further. And in a lot of cases where prices are now, certainly much better than it has been over the last couple of years. And so any little improvement there can be helpful. If the NOPA data is confirmed by the USDA next week, I guess, then you might start to see a shift in market sentiment and soybean oil becoming a little bit more favored than soybean meal. That will require at least a tapering in the growth or steady domestic soybean meal demand. So if soybean meal demand keeps growing, then I don't know that we'll get a lot of liquidation of those short oil share positions. But if it doesn't, then I think that that you could start to see meal and soybeans fall and soybean oil rise a little bit, but the decline in soybean prices will ultimately limit how high soybean oil prices go. And then ultimately, I think this probably will be the beginning of the trend in oil share that takes oil share above 50% and starts to drive the crushers to match their crushing volumes with soybean oil demand rather than soybean meal demand. Outside of that, one of the things that I wanted to talk about today, or I guess there's one other little bit of data that we haven't really gotten a chance to completely update yet, but the EMTS data came out on Thursday, and generally that was a little bit, production was a little bit below where we were expecting. I think particularly in renewable diesel, it looks to me like renewable diesel production was probably about 210 million gallons, or well, that's certainly what renewable diesel production was in October. And we were expecting 240 million. And so we're a little high there. On biodiesel, it's sort of the opposite, not to the same extent. We were 139 and it came in at 144. So not a huge difference there. Even on the renewable diesel, again, I haven't really gone through all of the details of it, but I would be really surprised if we made significant changes to our 2023 forecast based on this month. That said, if the sort of slowdown in renewable diesel production, so in September, renewable diesel production was about 235 almost million gallons. So if October production is a reflection of what's happened in margins, what's happened with RIN prices, what's happened with the industry broadly over the last couple of months, ultimately we may need to cut our 2023 forecast. We don't have a lot of time left, obviously, in 2023, so I wouldn't expect a significant cut. However, I think probably the follow-on impact in 2024, or our outlook for 2024, would be where you might see a little bit bigger change in our production forecast. But I'll talk about that when we meet again next week, and I'll let you know what we did and in the changes that we made. All right, outside of that, the thing that I wanted to talk about was the new IRA credit and the impact that that's going to have on the industry and on feedstock demand. So many of you, most of you, maybe all of you will have heard about the IRA credit and maybe know how the credit value is calculated, at least from a high level, I guess. And that's kind of about where I have been. I knew that it's coming and I knew that it was going to incorporate CI scores, but I hadn't really dug into how it was going to incorporate CI scores. And so I did that this week to kind of get a sense of what might happen to the biodiesel industry after the implementation of the IRA tax credit. And generally, if you don't know how this is calculated, I want to share my screen here with you really quickly. All right, so generally, there are two credits that are important to us. There's a SAF credit, which I go through here, and then there's the biomass-based diesel credit over here. And so for the SAF credit, and both of these kind of work the same way. The main difference is really in where the base is, and then how the addition or subtraction from that base credit value is calculated. So for SAF, the base credit is $1.25 per gallon. And then for every 1% reduction that your fuel makes relative to a baseline carbon intensity or carbon production, I guess, every 1% decrease gets you another penny per gallon in credit value. So in this example, if the baseline is 89 for standard aviation fuel and your SAF has a CI score of 20, then 20 is a 78% decrease from 89. And then you subtract the 50% reduction goal. So below 50% reduction, you don't get any additional. Above 50%, you get, again, another penny per percent that you're reducing. And so the difference between 78% and 50% is 28. So we're going to add 28 cents to the $1.25, and that gives us a final credit value of $1.53. It seems like the SAF credit is a bit closer to the LCFS than the biodiesel credit in some ways. It seems like, from what I've read, and this could be wrong, from what I've read, it seems like almost that for SAF, there will be, if not individual pathways, at least there will be a CI score that is more closely tied to the individual production facility than on the biomass-based diesel side. And that's the part I think that's maybe a little bit more like the LCFS. On the biomass-based diesel side, essentially what's going to happen is the IRS is going to publish a table of CI scores rounded to the nearest 5 for each of the feedstocks. So what we've done is just kind of taken the average CI score from the approved pathways under the LCFS and use that as the CI score. The IRS, I think, is going to publish this every year, this table every year, and we don't know what they're going to do. So it's unclear whether they'll do the same thing and take the average of the pathways in California, or if they'll come up with their own calculation for CI scores. We're using the averages just for illustration. And so canola oil with a 52 CI score gets a 50. And essentially what you do is you subtract that CI score from 50, and then you divide that by the CI score by 50 again, and then that gives you the reduction in carbon intensity. And and then you multiply that times the base of the credit, which in this case is $1. And so you can see for canola oil, you basically get no credit. For soybean oil, it's negative, so you get no credit. But for distillers corn oil with the CI score of 37.7, you essentially get 20 cents per gallon in credit. Now, this is going to replace the blender's tax credit, which is $1. And so the net reduction in revenue for producers using distillers corn oil will be 80 cents. If you go down the CI score ladder a little bit and you get to tallow, which has a CI score of 35 in this example, your credit value goes up to 30 cents. And if you get all the way down to UCO at 25, then you get 50 cents. Same principle for biodiesel. The only difference here is the CI scores. Now, there may be a difference when the IRS publishes these in the CI scores for the commodity or for the feedstocks, whether they're biodiesel or renewable diesel. That would make sense to me, since the CI scores are different in the approved pathways under the LCFS. But it's not entirely clear to me that there will be sort of two separate tables, one for renewable diesel and one for biodiesel. again, it might be in there, it might just not have gotten included in the research that I did. And again, as you move down the CI ladder, you can get up to sort of 60 cents based on the average CI scores that have been approved, that have approved pathways under the LCFS credit. So it's not necessarily that that there's a different process for renewable diesel or biodiesel that favors one or the other. This is all just completely driven by the differences that you see in these tables between renewable diesel and biodiesel are just driven by the average CI scores of the pathways approved under the LCFS. And so here again, we're going to get between sort of a dollar decrease in revenue and a 40-cent decrease in revenue. And so what I wanted to show was the impact that that would have had on biodiesel margins. If you'll bear with me just one more second here. Shoot. Sorry. Bear with me, and I am going to share my screen. I'm not doing it right now. Here we go. Okay, this one. Okay, so this chart just kind of simply shows the margins that we reported for biodiesel, the weekly margins that we reported for 2022, and then I've adjusted the margins based on our calculated value for the IRA credit using soybean oil as a feedstock, and then the implied margin using used cooking oil as a feedstock. So the two ends of the IRA credit value spectrum. And it basically just subtracts off. So for our average, for 2022, our average margin was just over $1. We subtract out 30 cents in the average margin. I'm sorry, our average was 71 cents in 2022. You subtract out 40 cents for UCO because you get 60 cents of the credit, but you're losing the 40 cents. You subtract out that 60 cents, and that gives you an average of 31 cents. That's all kind of easy to do. I put the chart together because I kind of wanted to show how infrequently biodiesel would have been profitable since 2020 if we had the IRA credit instead of the blender's tax credit. And so if you are a producer using a biomass or a biodiesel producer using used cooking oil, you would have been basically about break even for a good chunk of 2020. 2021 would have been a really, really tough year, and you would have made a bit of that up in 2022 and early 2023, and then kind of back to about break even based on our estimates. And then there's a little bit of, I just took the biodiesel margin estimate that we report that's based on 75% soybean oil and 25% yellow grease. So it wouldn't be exactly this cut and dry, but I wanted to make it pretty straightforward and not over confuse it by having a couple of different feedstocks. So it wouldn't be exactly this, but again, the trend would be pretty close to this, I believe. If you don't use UCO and you use soybean oil, then you weren't close to break even in 2020. 2021 was even worse. 2022, you got back to break even for a little bit, and then 2023, you had a really, really tough time. And so it seems likely that while early sort of predictions that the change to the IRA credit would limit or nearly eliminate the use of soybean oil, that still doesn't necessarily, I don't think make sense just from a how much feedstock is out there and how much can be used. That still the limits on fat and grease supplies still suggest to me that we're going to need to use soybean oil in biodiesel production or renewable diesel production. But if these economics are close, then it's going to be very difficult for biodiesel producers to make any money, whether they use soybean oil or use cooking oil. Now, if they use cooking oil, again, there are times where they are break even or a little bit better than break even. And then last year, of course, they would have done relatively well. But if sort of the steady state is kind of break even, then it's going to be really, really difficult not to be fairly aggressive in our reduction of biodiesel capacity. There are a couple of things that will impact our outlook for biodiesel capacity. There are state credits that are targeted at biodiesel, and we're going to dig into those so that we can, before we really start to hammer our biodiesel capacity forecasts. But it's unlikely that any of those state credits and in the state credits that we have looked at so far are generally kind of a couple of cents a gallon or maybe a little bit more than that, but aren't sort of offsetting the 60-cent loss or the 40-cent loss or the 20-cent loss even that comes from switching from the blender's tax credit to the Inflation Reduction Act credit. And so it is a little tough to see exactly how biodiesel capacity isn't going to come down once we switch over to the IRA credit. Now, I still do believe that broadly that biodiesel can find markets, niche markets, either because of the geographic location of a facility or the market that the facility is serving, where the economics can be better than what we see in this chart. But it does kind of reinforce the idea that that's sort of what it's going to take for biodiesel producers to continue on. That's where I am right now, honestly. And it doesn't necessarily mean that we're going to cut our biodiesel production capacity forecast really, really aggressively, but that's kind of what this chart would tell you. I think what I'm going to ultimately find is that some combination of state level credits and maybe a little bit of a premium for being in the right location or having a really good feedstock supply will probably limit the most aggressive stance I could take towards reducing biodiesel capacity forecast. However, unless I find something that really does sort of balance this out so that the equilibrium is not sort of break even, that it's positive, it is going to be hard to keep biodiesel capacity at 2 billion gallons. Beyond that, in terms of feedstock use, this will obviously favor the low CI feedstocks much more than the vegetable oils, which will make competition for the low CI feedstocks and sourcing low CI feedstocks from countries outside of the US that much more important going forward after we make the switch over. So if all of this works out this way, then I think what potentially could happen is you get the US biofuel industry importing every ounce of tallow and used cooking oil and choice weight grease or poultry fat that they can find in the world in order to qualify for the IRA credit. And you can still qualify for the credit if you import the feedstock, as long as the fuel is produced in the U.S. And so the competition for those low CI feedstocks not in the U.S. is going to be almost as intense as it is for domestically sourced supply. However, if we go out 5 years or 10 years, and the governments that look like they want to enact SAF mandates do in fact enact and implement those mandates, then there's going to be sort of a global grab for the low CI feedstocks, and the supply chain that has developed over that time frame to ship feedstocks to the US will suddenly probably sort of go away. And so even if you are a biodiesel producer or a renewable diesel producer, and you have then put together a supply chain that brings you used cooking oil, and then you get that from wherever, you get that from Australia, or you get it from Japan, or you get it from China. China would probably be the least likely to do this, but you get it from China, and then they make their own SAF standard and develop their own SAF production industry. That supply is not going to be available anymore. So that doesn't really have an impact on what's going to happen in the next year, but it may have an impact on the funding for some of the renewable diesel plants that have been announced. And it may have an impact on biodiesel capacity beyond the switchover. So you survive the switchover to the IRA credit as a biodiesel producer. You've got a good, cheap source of used cooking oil from overseas. And then that country enacts a SAF mandate, and then your used cooking oil supply kind of dries up and you have to start all over. That's an extreme example, and it's not something, again, that's going to impact prices in the next year. But in the longer term, that is something that seems, at least at this moment, like it is going to happen with a much better chance than sort of 50-50. So I think that that concerns about, I think the IRA credit probably ultimately will also work to reduce concerns about the food versus fuel debate. So if we're not using a lot of soybean oil in biodiesel production or renewable diesel production, then non-biofuel users should have more supplies to source their feedstock from, and it could even potentially allow the US to export more soybean oil than it has in the past. I don't know that we'll actually get to that part, or we'll go back to sort of exporting 2 billion pounds of soybean oil a year, but it could be that frees up enough supply that, one, the reductions we have built into non-biofuel demand over the years are reduced or eliminated, and the soybean oil that's available domestically is such that that we're sort of almost back to where we were in 2018-ish kind of thing. Again, there's a lot of pieces that have to fall into place, and that's something that's going to happen a ways down the road. But the IRA credit probably will have a bigger impact on not only the biodiesel market, but also the feedstock market than I guess I had thought previously. Because the key here, I think, is the standardized CI score. And Joao made a really good point this morning when we were talking about this, and he said it really takes away the incentive to improve the CI score of the vegetable oil feedstocks, for all the feedstocks, of course, because the IRA is publishing a table instead of you getting your own CI score. That'll still be important for the LCFS program, but broadly across the rest of the country, it does make it so that even if you use soybean oil, but then you do whatever to sort of lower your CI score, doesn't really make a difference. It will, however, if all of this works out this way, it will, however, shift demand away from vegetable oils and sort of temper down that, again, that food versus fuel debate. Okay, it's Thanksgiving week, and so I'm sure everybody is very busy trying to get stuff done before the long weekend. And so I'm actually going to be short today, or relatively short today, and that will be the end of it. The last thing I want to say before everybody takes off is, or if anybody has any questions, is we are still going through, and I feel like about once a quarter I have to come on and talk about our computer systems, which is the last thing I want to do. We're still going through this transition. The website should be reflecting our current forecast, and it should reflect those going forward now. However, there are still some weird things happening in our system. And so if you see something that looks weird on the website, or just doesn't sort of fit with the other data on the website, or just doesn't even appear potentially, please let me know, and so we can fix it and make sure that everybody sees it. And if you really need some data or some prices or something, until we get the website absolutely locked down, send me a request and I'm getting caught up on my emails, and so I will respond. I'm kind of doing it backwards. So the sooner, the earlier emails, those are the ones I'm responding to first. And then the ones from a month ago are going to be later. So I will see your email and I will respond if you need some data, just to make sure that we take the website out of the equation. All right, if there aren't any questions, then that'll be it, and we will be under 40 minutes for once. So I hope everybody has a wonderful Thanksgiving, and I will see you all back here next Tuesday. Thanks, everybody. Bye-bye.